Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the No Trader Show. So once again, we find ourselves with a pretty volatile market as the S&P has risen off of the recent lows, actually pretty decently when you look at it in percent terms. So we got back several percent of the recent decline. But this morning, S&P was down as much as about 20 points or so. It's now, as we record, down about 10. And still hanging in and around the 2,900 level, well off the highs of 3028. But again, in percentage terms, it's not all that much, but definitely the tariff issues, the yield curve, and falling rates are all issues that investors are looking at and getting, I don't know if we'd say overly concerned, but certainly there's been some selling coming in as there is some concern about what's going on and the continued trade wars, not just with China, but I think also in general, looking at the European and U.S. relationships and trade wars that still exist there, and just some of the pressure that's putting on as far as just global growth and how much these tariffs can affect global growth going forward. So in this week's show, we're going to take a look at, like we always do, we'll look at the S&P and sectors and stuff, but I really wanted to focus this week specifically on high-yielding stocks that meet these three requirements. And this is not the way most people would look, but I think what you do is you start pulling out the cream of the crop of even within the high-yielding stocks if they meet these three requirements, which is, first off, safety and preservation of capital. Secondly, management's willingness to sustain and pay a dividend. And third, which often people put as number one, is capital appreciation and growth of the dividend. So most people look at capital appreciation. They buy a stock because they're looking for it to go higher. We're going to filter this here by saying we're looking for stocks that can go up, but also that the chance of the dividend going up over time is part of management's goals. So I've picked out a dozen names. These are not the only ones that meet the requirements, but I picked out a dozen names here that we'll go and look at on the charts and see if they're good buys right now or where we would buy on a pullback that kind of gets you this safety and preservation of capital along with a chance for growth. So one guy I spoke to, an institutional guy, earlier this morning, I was telling him about this, and he said, there's a term they like to use, which is 4+4, meaning a chance for 4% capital appreciation plus 4% in yield, which gets you your kind of average long-term return on the market of 8%. But in a market that's more questionable, as it is now, a general marketplace that's more questionable, these tend to be a little bit more of safer names. So we'll take a look at them, and that'll be the bulk of the show. So as we always do, let's take a look at the sectors relative to the S&P. The right-hand part of this chart is current through yesterday's close. So these are all the 11 macro sectors versus the S&P performance-wise year to date. On the left-hand side, the same slide we used last week. So these you can kind of visually see the change from last week to this week also. And again, a theme we've talked about somewhat endlessly over many, many months is just how bad energy is. It got even worse this past week, falling almost 2% more versus the S&P over the last week. So energy's now trailing by over 15% and continues to be the dog sector in the market. And it's not just for this year. As we've said before, 8 out of the last 10 years, the S&P the energy sector has underperformed the S&P. And in relative terms to the S&P, if you look at a chart of XLE divided by SPY, you will see that we are on 19-year lows. So this is a sector that, on TV, you'll see some people on the business news channel starting, or they've probably talked about it before, but trying to do some bottom picking in energy, saying how cheap some of the names are. And indeed they are, but there's a reason they are. And at some point they will be a buy, but they still haven't shown up to be a buy yet. So if you choose them, choose so carefully and understanding that you're buying something that over the last 10 years has hardly ever worked. You could be in any other sector of the market besides energy and have done better. At some point that will indeed change, but you've got to decide if you're willing to, how long you're willing to hold on to something that may continually underperform, until it finally has a chance to at least hold equal with the market, if not ultimately outperform. What else has moved a fair amount last week? Staples are now up about 5.6%, better return than the S&P last week. That was down at around 3.5%, so that picked up 2% in the last week. Anything else here? Let's see. Tech did a little better, about another 150 basis points of outperformance, so that's done well. Notice materials, the black line, it is down almost 3% now year to date versus the S&P. Last week it was only 1.8. So despite a lot of people are looking at gold, which is of course part of the material space, gold stocks, but collectively the material space has actually underperformed by 1% or so in the last week and 3% on the year. So, StockCharts, this is always a great place to look on StockCharts.com to look at the relative performance of the sectors versus the S&P. And, it's just done visually well with the different colors to make it really easy to see what's going on. And because we also keep last week's slide and kind of just push it to the left and add the current weeks, it's easy also to compare week over week and see what's moving. So that's helpful. Lastly, I see also financials look like they underperformed by about 1% in the past week and continue obviously to underperform on the year with yields being low. So that's that. Let's switch over to our charts, and we'll start with the S&P like we do, just to kind of get a sense of what's going on. So we got, a month ago, we got very close to our 3032 target that we had in place since early June. We got to 3028 is the all-time high in the S&P. Accompanied with that, where you can see the circled sequential 13 signals that appeared. That is the DeMark model that we use. It's an institutional model that helps us define exhaustion of trend. And when I see those show up where against other targets that I had, in this case 3032, it often gives me a very good clue of, first and foremost, when not to be a buyer in an uptrend, and also potentially when to lighten up exposure. And that's what we've done for in the no trader clients. So we've taken some, kind of off the table, as well as reduced what we're buying and the type names we're buying, because we said it's finally time to at least really pause in this idea of just simply always buying. So we have lightened up long exposure considerably, and taken hit targets on many of the names we had, and only one or two did we get stopped out of recently. So that's been a good thing. Looking at the S&P now, the cloud chart, for those of you who know the cloud chart, is still showing some support. If you look at the bold blue line that is kind of scribbled across the entire chart, that is a line chart, but it takes current price and pushes it back 26 bars. In the case of a daily chart, it's 26 days worth of price action. Looking at this bold blue line, its current price pushed back 26 bars. So it's really where we are now, just push back in time. So this is a line chart. It's going to reflect each day's close, but in real time, as the market trades, it'll just follow where it is. But at the end of the day, you get one value, and that's the closing price. So what's important here is that the sell-off, notice these lows here came right into the bottom of the cloud beneath it. So even though price tucked underneath and had a couple of daily closes underneath. The lagging line did not close underneath its cloud, which means this did not break down. So you still have a generally bullish to neutral type of situation from the cloud chart. The 13s are suggesting exhaustion of trend. We broke down beneath the propulsion level at 29.11, but it has not broken down properly yet. So that still is, we have not gotten a qualified and confirmed close beneath 29.11. If we do, we would target 27.94, this level here, the propulsion exhaustion level, as first downside target. And there's also a level in here, which are a trend factor. That's a 5.56% measurement down from the high. This is also not broken, even though we had a couple of closes underneath. This is not broken correctly with a qualified and confirmed close underneath. So you've had essentially false breakdowns on the downside, support holding, and that's why we've kind of gone neutral. So institutional clients have gotten them into a neutral stance right now for a tactical point of view, and I think right now through the next, certainly through the end of the summer, the next week and a half, no reason to be aggressive in either direction. I think the market will likely hang out in here, barring a tweet or something unexpected. And I'm just going to, play the range or just take a more neutral stance here and not get overly aggressive in either direction. So that's what I see for the S&P. Now, let's take a look at the list of names, and we're going to start off with first name that was on the list was AT&T. So again, this is safety and preservation of capital, a stock where management's willingness to sustain and pay the dividend, and capital appreciation, as well as growth of the dividend. These are all kind of declared goals of the firm. So AT&T, interestingly, got, this is all hindsight here, but the bottom was made on a 13 down in December. Stock's moved up very well since. It's a defensive play. It's a high dividend play. It's what's helped. Now, of course, the market came back, but what this is getting a bit from also is the high dividend you get by being an owner of telephone. Would I be a buyer right here, right now? Probably not. And I'll tell you where I would. And the reason not is we've hit a propulsion target. This week's high went right into the target of 35 and change, 35.30. That's been around for over a month. The lagging line is playing with the top of its cloud. It's through it, but the week's not over, and it's not a defined breakout yet. So I'd say we're actually up against some resistance in the name. If I wanted to be a buyer, I'd probably be happier near, let's say, 33.5-ish. Or so. And if the market got hit and really took the stock down, but again, you're looking for this concept of some safety and preservation of capital, then 31 and small change would be another level. So those are the two key levels underneath. About 33.40-ish, give or take, and about 31.20 or so, 31.15. So those are levels that on a pullback, I'd want to be a buyer of telephone. In similar company is Verizon, at least, when I say similar company, I mean in the telephone space. Different looking chart, and I'll go back to telephone for a second. So look, this peaked in 2016, sold off into the Christmas low, and it's kind of gotten about half back or so, just eyeballing it. Again, going to Verizon here, this made all-time highs in 2018. In fact, we kind of have a double, if not almost a triple top, just north of 60, anywhere between 60 and 61.5 or so, has three highs. But this still has cloud support. It's above where old highs were, and all these lows in here in late 2018, early 2019 were against the highs back in 2016. So this is holding in. This, I'm more apt to be a buyer in here, or at least if I have the name, continue holding it, versus AT&T, which is on the cusp of a breakout but hasn't broken out yet. So this, at least for right here, right now, looks like the safer hold. And if we can get the more Friday closes, we can get above 55.16. that come after a week that had a down close. So one of the things we look at for a breakout on the upside, and again, these are institutional models, and the way they're going to look at things is if this week closed above 58.16, which is where this kind of teal colored line is, that would not necessarily be bullish, because last week you can see was an up close to the week before. So generally what I want to see is a week that closes down relative to the prior week and then close above that level and open up higher the next Monday. That's generally a better breakout. And if that occurs, then this says that we should test 62.5 to 64.5. That's the upside here. The downside, I don't see. Clearly, this is, you're going to want to see it stay above the bottom of the cloud. So 53.83 or so on Friday closes. Breaking underneath it is not necessarily bad because it just puts you back into the range. But let's just say it's better staying above than not. Let's, what's next? Wells Fargo. So clearly a bank that's had issues, and the stock is well off its highs from early 2019, set up 9 count on the high not that long ago, looks like earlier this summer or spring, I guess it's June. We have a 13 here looking for exhaustion to the downside. You got a good rally, stalled at the cloud, and is now selling off again. So in the idea of that stocks may still come down, but this meets the category of those three things we were talking about, then I'm a better buyer in that kind of 41 to 39.5 level if it gets there. So look, if I just look at where some old lows were, and we take this low here in 2016, the Christmas low was there, this year's low is there. If we break underneath that, this is going to get to the low 40s and possibly break under 40. So that's downside risk, but if you're looking to be a buyer, then I kind of look at those levels as that's a good opportunity to come in the name that's beaten up, but again, meets the requirements of what we're looking for. On the upside, if you're a holder of the name, you need to see, I kind of want to get this back over 51 and change or so to really think that this has made a major bottom and has a chance to turn around and get back much higher. So you're buying this again for chance of small appreciation plus the dividend. Qualcomm. High dividend, safety of preservation of capital, etc. So here, this bottomed in 2016, has definitely got a solid base in this 50 level. You've got lows here, 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 3 real lows. Looks like some type of ascending triangle. It broke above, but I'm just connecting highs here. It's pulled back in. So in the scheme of things, I think this is decent too. There's no counts on the upside that are finished. So in other words, there's no 13s in the way of saying that we've exhausted ourselves to the upside. So even at current levels and minor pullbacks here in the 70s, I think this is a name that you can buy, again, for the dividend yield and the 3 elements that we're looking for. So this is one of the ones that's looks like one of the clearer ones to be able to buy at current prices and on minor pullbacks. Carnival Cruise, CCL, does meet the requirements that we're looking for. So the question is where to be a buyer. And on the weekly chart here, we do have a 9 count. What I would be looking for in order to feel more comfortable owning the name is to get, let's see here, 1, 2, 3, 4. I'm going to blow this up. And if at this point, there's 2 things. You can either play this as it's got real trouble and it's going to dive down to 32, which would be a massive hit, or this consolidation is building a base for something to move higher. At a minimum, what I want to see to even consider buying this is a close a Friday close above the close from 4 Fridays back. So like this week, 1, 2, 3, 4, you would have to close above 47.27 this week in order to give me any chance of being a buyer. And looking at this whole area in here over the last 2 months as being, you know, there's definitely buyers here because it's halted its decline. So there are institutional buyers buying this, but of course there are sellers offsetting it, but the stock has not fallen anymore. So I need to at least see something positive, and that would be, as I said, close this Friday above 47.27. Next Friday, all you'd have to do is close above 45.96 in order to get that potential of a price flip here. Otherwise, the longer this can't rally, the more you open the door for this to take a dive. So you may want to buy a small amount here. And if the market dove and this stock went with it and we got down to the low 30s, that's where you would be a much bigger buyer, again, based upon the goal of what this filter was and how we found these 12 stocks today. Cardinal Health, also a name that's, as is the whole health sector, has been under pressure. The bulk, in fact, this name's been under pressure for 3 years, so the rallies are minimal. Notice the cloud chart, the lagging line has not gotten above its cloud the whole way through. So this has been in bearish mode for years. Downside target, we're getting very close to 39.94. So let's just call it 40 bucks. That downside target's been in place since April of this year. We've gotten as low as 41. So we've gotten close. It's trading 44. So, you know, if we get down there, you might want to do some buying there, again, for the dividend and the chance for some small capital appreciation, but it's considered, it is yielding over 4% at this point, and that's part of the reason that this filter, that we ran the filter the way we did. But clearly you're fighting trend here. You know, this has been a bad name for quite some time. And that's sometimes what happens is that, you know, you come up with stocks on a filter list, but you look at this chart overall, it's a bad chart. But it is getting closer to this 40 level that would indicate exhaustion of trend. I'm trying to see, and if we look back here, this is kind of where it broke out from too. So this is, you know, the last low made is just about where we're trading here. Go back to 2013, the last low made before this flew to the upside is essentially where we hit a week ago or 2 weeks ago. So you're in the neighborhood of where you could easily get one of those bounces. What do we have next? NTAP, Network Appliances. So this has obviously gotten crushed, but notice that we are, a couple weeks ago, we hit propulsion full exhaustion at 45. So this is a name that, despite that it's been destroyed, actually suggests that you're in a place that, as far as safety and preservation of capital and dividend at this point, you've possibly seen the worst, having hit here. And over the next few weeks, I would think that this is not a bad buy. This line coming in here is not really there. It's a holdover from the chart we just looked at. So let's take it away. And I'm just curious. Let's look at this on a monthly chart. So here's the monthly cloud. Also 13. I'd still look to buy this on weakness, even despite the fact that it's gotten crushed. I think it's probably not a bad name, considering that we're getting back into where years ago this, again, you know, kind of built its base and broke out from. Southern Company, SO. So this is one that is virtually on its all-time highs, but showing some signs of upside exhaustion. It was 13 here, 13 here a few months ago. We went sideways for weeks. So this name, again, meets the list. Would I be a buyer here? I probably buy a small amount, but not much. I'd rather be a buyer down at 55 3/4 on a pullback to this propulsion level, and leave a little bit to buy at 52 and change. But this is obviously rocked since the Christmas low. It's climbed up the cloud model's conversion line, the first level of support in the cloud model. But I can't help when I'm staring at a 13 like this, I'm generally not a buyer. I really rather be a buyer here on a pullback, 55 3/4 to the low 52s or mid 52s or so versus the current 58-ish. Duke Energy. You can see a mess of 13s also that have appeared near highs. 13, major pullback. A slew of 13s in here, major pullback. 13 here in spring this year, decent pullback, but closer to 5-6%, something like that. But this stock keeps coming back for more. And we're only a couple weeks away from another 13. We're still beneath the propulsion exhaustion level. That makes me, I'd be a buyer in a pullback. Anything near the top of the cloud in coming months. So if we got in the 88-ish neighborhood or so as we get into fall, I'd expect some support there too. And in a big picture, if this thing keeps going to the upside, it's saying it can get as high as almost 102. So still good chance for price appreciation before hitting its full propulsion exhaustion target. And you'll have to deal with some back and forth coming off of the 13s. So again, better buyer near the top of the cloud, and buyer again near the bottom of the cloud if that opportunity came. So next is Philip Morris. This one, you know, I've said to you before, I have certain things I won't buy. I don't buy any stocks that have to do with the smoking industry or were the smoking industry. Obviously, there's Altria and Philip Morris. But let's just look at this from a pure technical point of view. 13's showing near bottom, rally from it, one final 9 down into a 9 up, and now sideways. So this is kind of just basically where it was 6 and 8 months ago and a year ago, actually, right? I mean, this is the early part of 18 over here, so the stock has gone nowhere. So again, small chance of price appreciation, at least 4% dividend yield. So right in here, I'm okay being a buyer. PBCT, this one has weakened as many banks have recently. I mean, let's take, if we, all right, so double bottom, we're getting close to that again. We're on a 6 count, so in the next few weeks, anything near here at least gives you a chance. So I'd be a buyer on weakness here to $13.50 to $14. And I think we had one more, BCE Corp. 13's here on the bottom last year, getting close to propulsion exhaustion signal. So where am I a better buyer? 44.5-ish level. And into the, as we get into winter, also if we get towards the top of the cloud, but so 44.5-ish, give or take, is where I'd be a better buyer. So that's it for this week. I will be a guest on Thursday on Market Watches Live from 12:15 to 12:45 Eastern Time. Catch me there. We'll talk about some new things. And again, the best way to get in touch with me is Rick at inthenowtrader.com. And of course, check out our website, inthenowtrader.com. Lots and lots of videos there, as well as the intent here and what we do is bring individual investors access to models that they have, that they can't get their hands on or know how to use that institutions use. So that's it for this week. Thanks for listening. I'm Rick Bensignor.